Hi, welcome to Real Talk. I'm your host, Chris Rogers. My guest today is a financial educator. We'll be covering some important subject matter dealing with financial literacy. In addition to that, we're going to be talking about taxes, savings, and investing. Andrej, how are you doing, brother?
Good. How are you, Chris?
I am good. So you want to tell us a little bit about yourself?
Yeah. First of all, thanks for having me.
Welcome.
Amazing. But yeah, so I actually come from Slovakia, which is in Central Europe, or here people say, it's Eastern Europe because it was part of the communist bloc before, right?
Absolutely.
Obviously. But that's where I was born. I grew up first 18 years of my life. And then, my father married a Canadian, and he was like, I'm moving to Canada. Are you coming? Sure. So,
Okay.
But anyway, so I moved in here, and so my adult life basically started here, right? So I graduated high school, came here, didn't really speak the language much.
Well, your family's here as well, right?
My dad lives in Victoria, so
okay.
that's where we lived for the first 6 years.
Yes.
And that was kind of like, I was kind of the immigrant because obviously Victoria has a lot of just like Canadians, not like Vancouver, right? And when I moved to Vancouver, I was like, oh, cool. I belong a little bit more because everybody's from somewhere.
Feel more comfortable here.
Yeah, of course. It's a big community, people from my country and all kinds of stuff. So, so basically I had to do some schooling for my English, for the PR, for my citizenship. So I did college in Victoria, which is basically English. And then, how I got to what I do is basically, my dad was working for some financial companies in Europe as well before. And so he was, looking for something as well because, first of all, money is in the money business. And
Yes.
what better business than helping people create money than, that was the number one
So you were
thing.
inspired by your dad.
Eventually, not in the first place, because the first place is basically the second side of thing. Is like, how can you play the game of Monopoly if you don't know the rules? The government knows the rules.
True.
And most people don't. So who do you think is going to win every time?
The government.
Government, right? And that's, we can see the stats. 95% of people in Canada and around the world, not just Canada, are struggling to retire, right?
Yes.
So if you break that down, about 54%, the recent stats actually are 54% are dependent on their family members or the government to take care of them, and almost 40% of the other 40% are still working. So do you know it's because they just plan to fail, or they just fail to plan?
Yeah, I see.
Right? It's the cliche to say, but that's the reality. And so, that's what I'm thankful to my dad, because he didn't want us to be the
And
part of the
is he still
statistics,
involved
right?
in the
Yeah,
industry?
he's one of the people who trained me
Wow.
and coached me. But at first it was like, hey, like if you want to live in this country, like we moved to this country, wouldn't it make sense that if we actually learn how the money works in this country, so we can be better off?
Very smart.
Because we sold a house in Slovakia and moved here, and then it's not much because the houses are cheap. It was probably like a few tens of thousands of dollars, but now you have all this money and you live here, and then, well, what now? Do you know what to do with the money? Well, we didn't, right?
Yeah.
We're part of those people who don't. So a few years later, there's no money and no house, and now what? So he was actually seeking how to learn. But then, I was 19, 20 years old, so I didn't really care, right? All I wanted to do is play punk rock and skateboard.
But did you know, I mean, even at that young age, did you know that you were going to get into the financial sector?
I actually didn't think about it that time. It was basically...
Did he pressure, like your dad,
it was
did
basically
he?
forced. He basically kidnapped me. I was kidnapped and brought into a meeting where it was financial literacy. And it's the funny story because I remember that the guy doing the presentation that day, they were talking about mortgages,
Yes.
right? And I had no clue what mortgage means, not even in my own language. But I graduated from French, and mort means death, right? So I was like, why is this guy talking about death?
Yeah.
It's like, what's going on? Wants to help. I'm like, yeah.
So what was the first thing you did on your path to where you are right now? What was the first thing your dad advised you, if any, to do?
Basically just to learn and then to apply, right? Because like getting to where you want to financially is not a rocket science. It's basically just simple knowledge and common sense, and then you apply the knowledge. It's applied knowledge, not just knowledge, right? You can read all the books in the world, but when you don't apply it, you're not gonna get anywhere. So you have to apply it to your own situation, and then basically have the goal, like calculate what your goal is, or not even calculate, just know what your goal is, and then do the plan and just stick with it.
Yeah.
And then just discipline, habits, the self-discipline, and the, let's call it work ethic as well. And then you just, when you're on the track, just keep going on.
Fine. Yeah, people don't admit this. When I first met you, I was listening to you and I'm like, this guy's making sense, and I wanted, but I knew deep inside I wasn't ready. I became, how should I say it, at what point I was ready? I think about a year and a half, 2 years ago, because I got to a point where I started making, I would say my income sort of doubled.
Okay. So you
since we
felt
met.
comfortable that you can do something.
But yes, but this is the kicker. I still don't feel like I've gotten ahead. I like, even though my income almost doubled, I still don't feel any better off financially than I was back then. And that's what prompted me to want to, like, do something about it. So I started doing research on my own. I didn't want to go and get anyone else involved as yet. And for the last 2 years, I've been, doing my quote unquote research. And what I found, or what I discovered, it's not that complicated.
Exactly.
2, I work for that money. Not that I don't trust financial. I do, but it has to be someone I trust and I feel comfortable with.
Yeah.
But it took me a while, and I started tipping my toes in, and I started seeing a little results here and there, but only because I took the time to do my due diligence.
Yeah.
I didn't go in blindly and just be like, okay, I'm going to throw money here. I'm going to throw money. I'm going to buy Tesla stock. No, I just buckled down. I did research, read some books, watched every video I can find on personal investing, and I started slowly. And then I'm like, okay, at some point I need to get someone who's professional, because at the end of the day, I don't want to get my head into that space, because I hate to say, and no offense, financial stuff is boring. I can't.
The regular stuff is boring.
Yeah.
But once you apply it and you see the goal, it's become so exciting, because you're moving, right? Because happiness in life is like, progress is happiness, right?
Yes.
If you're progressing, like, I don't know, you play an instrument, you learn a new song, you're so happy about it. So it's the same thing with your financial stuff, right? If you're progressing with your financial situation towards your financial goal, it becomes more exciting. So, but like, you see how you felt, so now you see how 90% of the other people who are in lower, let's not call it lower, but not as good position as you were when you started fidgeting with it, how they must feel and how lost they feel. And like, sometimes it's like, because I have a lot of friends who basically, not that they ghosted me, but they didn't talk to me for a while, and then they come back and they're like, hey man, like, I'm so sorry I didn't talk to you, I just wasn't in a position financially to talk to you. And I'm like, well, that's exactly when you should talk to me, because it's all about that foundation. Like, before you start to do it, if you knew that information before, maybe you started to do it faster or better, or maybe a different strategy, and maybe you would think that, because you would think, and now you felt like, oh, I wasn't ready, but maybe you were, you just didn't know about it, because you don't know what you don't know. But maybe I know something that you don't, right? So that's something that I want to kind of bring out in people, because they can't imagine, right? Because a lot of that information that they're getting is like, let's say you're talking about investing, it's like, oh, how much money do I need to invest? Everybody asks that. Be like, but that's the wrong question to ask. You're like, well, what's your goal?
Always had this idea that it would take thousands, if not tens. Because in my head, I'm like, investing, oh my God, you need a lot of money to do that. My thing, and when I think of investing, or even approaching this whole subject here, savings, for me, that's one of the really important things for me. And I just want to basically touch on it a little bit. What's the best strategy for me, or anyone out there who's watching this, in order to save more money? What do you recommend?
Well, it's a really good question, Chris, and I'm pretty sure that, most people are asking this question, because when they're like, hey, Andrej, so what do you do? So I say, well, I run a business in the financial industry. So they're like, oh yeah, you're in finance. What's the best rate? What's the best investment? What's the best savings? Where should I put all my money? I'm like, because it's, when we say finance, people right away think it's just investments and savings, because it's the exciting stuff. It's the sexy stuff, right? Growing my money. But, if you look at the whole financial foundation, which you can imagine as a cake, right? It's like a 4-layer cake, or like a 4-step pyramid, let's call it, right? So you have actually, before you can actually save, because how are you saving? You have some kind of income, right?
Absolutely.
So your saving comes from your income.
Yep.
Now, what happens if you lose your income? Can you save? Not
No,
really.
no, absolutely
So
not.
wouldn't it make sense that we actually protect the income first before we start saving?
Makes sense.
Right?
Makes sense to me.
So
Yeah.
so the first layer of that is actually the proper protection, right? So what do you need to do to actually protect your income from, let's say you get disabled, you can't work. How are you going to get money? Let's say you get a critical illness,
But what percentage of people even think about that? Like, I never.
probably just that 5% that are financially secure, right? That
Okay.
95% who can't retire, they're the ones that we need to teach them how this works, right?
Yes. Yes.
So when you get sick, let's say, God forbid, you get a stroke. Now you can't work for 3 years. Now, where's that income going to come from, right? So that's the second type. And then
Yes.
the third type is you need to protect the income from the, premature death.
Wow.
Let's say you have a couple of kids and a wife and a mortgage, and now one day, God forbid, you don't come home. Now, how are they going to pay the mortgage? How are they going to go to school? Where's that income going to come from?
Very interesting.
Right? So if you started to save, now let's say that scenario, let's say that person doesn't come home. They
Yes.
started to save 3 years prior, maybe, a few $100 a month. Now, what is that few thousand gonna do for that family if he doesn't come home? How long is that gonna last? Maybe a few months, right? But what if they had some kind of insurance, right, on his life, maybe in case of disability, case of critical illness? So, he doesn't come home. Now, all of a sudden, there's, $250,000, $500,000, million, depends on how much insurance he had. That
Okay,
could
so
probably
I
save the
basically
family.
put the cart before the horse. You're saying, think about protection.
Yeah.
Protection. Think about protection, and you're gonna have that income. But think about protection. But also think about what if something goes wrong.
Yeah, exactly. You always have to have, because it's also my upbringing a little bit, right? Because there's still that kind of post-communist mindset in our country, and we always are like, what if?
Yes.
Like, am I covered? Am I good? We're always stacking those, cans of food in our basements. What if the war comes again or something, right? So that's kind of, it helped me as well. Like, it's kind of like a double-edged sword, right? It's
Yes.
you kind of still like, what if? But again, what if?
But
And
what
then you
what
cover.
would you recommend as an educator? What would you recommend to a client? What programs out there that you'd recommend? Like, let's say I come to you and I say, hey, man, I want to start saving more money, and I have this cool income or great income. How do I protect it? What are the programs out there that you can offer?
Yeah, so first you need to look at those 3 areas: protection of income in case of disability, in case of illness, and in case of premature death. And then it depends, right? Like, there's nothing like nothing that like fits all, right? There's no one product that's going to be the best for everybody. Like, we have to shop around the industry. We have to shop around even the same, like, different company can have like a lot of different things, right?
Yes.
They can have, like, you look at life insurance, there's a temporary, there's a permanent, right?
Yes.
So temporary is just for a temporary need. Let's say you have a mortgage, you have 20 years left. So you just insure that 20 years. It's going to be cheap. After that 20 years, you don't need it, you cancel it. That's it.
Yes.
Let's say you have kids that are 10 years old. When they're 18, they're going to school. You don't need to take care of them anymore. So you just get insurance for 10 years. It's a temporary need. Or you have a permanent need, right? Where you can actually
Interesting.
connect with your savings, and that can actually be a stream of money for your retirement. And then you can even use it as a legacy for the next generation, right? Because that's the only guaranteed thing is death and taxes, right? So, you know that unfortunately one day we all gonna die.
Everyone.
And so we know that if we have that permanent insurance, one day that money goes to our family tax-free in this country, which is pretty good. And then, if you look at the critical illness insurances, again, there's a lot of different types. There's something that gives you your money back. There's something that is cheaper but doesn't give you your money back. There's something that increases the cost every 5 years, something that is the same cost until you're 75. So again, like, it's very individual. So the best thing is just to sit down with somebody who knows what they're talking about.
I was going to say that because I'm like, I wouldn't know this information unless I literally become aware of it and go out and actively look. But still, I don't have the,
you wouldn't know what to look for.
I wouldn't know what to
if you don't know what you don't know, you don't even know where to start. Because a lot of people say like, oh, I can just Google it. Well, okay, go ahead. But what are you even going to type in?
You'll just get a bunch of stuff and you'll just be like, okay, what do I choose?
And it's going to be contradicting.
Yes.
And most of it is going to be from the US. And they have totally different stuff, right? Because people tell them like, oh, do you do like a 401ks? And I'm like, that's a totally different country, man.
Yeah.
Like, it's the most similar thing would be an RSP here, but still, right? So it's like sometimes they don't even know.
Same thing. It does the same thing, but it's just America.
It's very similar,
Canada.
but it's a different country. So sometimes
does
it's
one
like,
whole advantage over the other, or is just like across the board, they're pretty much the same?
I mean, I can't really talk about the U.S. stuff because I'm not really educated about it. I don't know exactly how it works because I know the stuff in Canada.
Yes.
But from what I understand, it's pretty similar. But that's the thing, right? Like we don't even know what to search for, and we're bombarded for all of these TikTok superstars that are amazing in finance, and they teach you how to be rich and all that stuff.
The
right? So it's like
I get tired. You know what? I get anyway. I'm not gonna go down there. Road.
It's a really deep rabbit hole.
Yeah, these people just come out and they speak with such confidence, and I know there are people that are being like, "Oh my God, let me write that." And I'm not saying that all the advice bad. What I'm saying is that some of these people are clearly not qualified. I think they're just trying to make money, or they're trying to sell you a course, or trying to do something.
Yeah, because they're just kids that learn it from somewhere, and they're like, oh, people make money on these apps now. Okay, I'll just talk about something interesting that people want to learn about, but they're not like a financially, licensed. They're not licensed professional by the government, so they legally can't talk about it, but they still do. And then all these other kids might get a wrong advice of that, and then they go and they might not get the right product. So that's why, you need to have somebody who actually shows you all the options and then educates you about each option, how it works. And then you should be the one to choose, okay, I need this one because of this and that. And I'll be like, that's a good point, Chris. Yeah. So this one is the best for you. That's great because of this and that. And then we agree, and then we go ahead. Because I'm not even going to do a plan for you if you don't understand what you're getting, because chances are you're going to screw it up few years down the road anyway.
Most likely.
So I would be basically just hurting you anyway.
On my journey though of becoming financially literate and doing my own research, I was hearing a lot about emergency fund or creating an emergency fund, and there are different schools of thought on that. When it comes to how long or how much do you save by month? Do you do it monthly, or how does it work? Because I did it. I've done it, and I do it personally. I just, how should I say it? I saved up by the month. So I did a couple of months. I'm not going to go exactly because everyone's different. We all have different, financial.
Yeah. So that's the next. So actually the 4 layers, if we go back to that financial foundation,
yes.
I'm pretty sure you're probably going to show it on the screen so everybody can see what I mean, is, the first layer, we have that proper protection. Now the layer on top of that goes as the debt management. So we can get into it as well a little bit, because that's, whole another topic. Everybody has different debts. There's a lot of different strategies how to get out of debt. Yes. And then the third one is emergency fund, and then is the investments, right? So if we talk about the emergency fund, it should always be like a liquid account. Like, you don't want it locked. You don't want it like fees. You don't want it
access to it.
Yeah,
when
you need access.
Emergency.
In emergency, so you don't go to credit card debts, because once we go to credit card debt, how do we feel? It's not a good feeling, right? And then, most people stay there, and then, that's the other thing I want to touch on with this is that I don't know if you ever heard of the rule of 72.
I've heard of it, but I'm not as familiar.
Yeah, so basically the rule of 72 just simulates compound interest. So basically 72 is a constant.
Yes.
And so Albert Einstein actually called it the 8th wonder of the world. And so basically what you do, you just divide the rate of return that you're getting or getting charged on your money into the number 72. And it's going to tell you approximately how many years it's going to take for the money to double. So, you look at credit cards, what is it, 20%? Now, if somebody owes
Some
10,000, 20%, they only pay the minimum. So, 10%, what is it, 20% credit card rate, 20 goes into 72, 3.6 times.
Yes.
So now every 3.6 years, your debt doubles. Now,
Wow.
do most people pay off their credit card in 3 years? Not really, right? So that's why a lot of people are just getting deeper and deeper. I have countless examples. A guy tells me, hey, so I owe like 7,000 on my credit card. Last year, I'm paying always the minimum, and a year later, I owe 10. I'm like, well, yeah, because it's 20%. You're gonna owe 14 in 2 years.
Wow.
Right. So then there's some strategies how to get out of the debt. Right. So that's the whole debt management area that people
And
should realize.
you teach that.
Yeah.
To
So
your
we
clients.
teach that, and we do a lot of workshops about that and stuff. And then if you look at the emergency fund, again, it shouldn't be something that kills you in debt, or something that kills you with let's say your emergency fund is in stocks or crypto, or a lot of people do crypto these days. What is crypto doing now?
Is it better, the emergency fund? I want to ask this question because is it better to keep it separate from your regular bank that you do business with? Because personally, again, with my little journey, I have two banks.
Mm-hmm.
I keep one bank for my expenses and rent and blah, blah, blah. And then the other one for investments only. Yeah. Is that something that you also teach? Is that a good strategy?
Yeah, if it gives you more discipline of not touching it. Because you know how people are like, oh, I got 8,000. Well, can I spend it? Well, nah, that's for your emergencies.
Yeah.
Right? So it should be like a separate account, right? Even a separate savings account. Like it just has to be something that is easily accessible, and it's not locked, and it's not like volatile. It's not like, I know I have 8,000 in an emergency fund, and when the emergency comes, it's worth 3, right? You don't want that. You want something that always going to be the amount that you need, right?
Yes.
I mean,
absolutely.
yeah, you're losing some growth, but that's not the point of that money. It's for that emergencies. So the emergency fund, if you don't have any, you have to start with something. Just your first goal should be always $1,000. Mm-hmm. Once you have
start
that
with
$1,000,
put 1,000 in there, and
if you have that 1,000, a lot of people don't. So maybe they save, I don't know, $20 here, 20 there. But once you hit that 1,000, then you want to increase that 1,000 to 3 months of your income. Some people say it's 3 months of your expenses.
Yes.
But for me personally, it's like, like let's say I cannot work those 3 months. Yeah. Now, am I just paying expenses? No, I still want to live, right?
Yes, absolutely.
So if I have that emergency, unless it's some kind of like, I'm bedridden or something, then obviously like I just want to pay my expenses. But it's better to have 3 months of your income. And once you have that 3 months of your income saved, then you go for 6 months of your income. And I feel like 6 months.
So you do it in stages. Well, what I did was because my rent, of course, is my biggest expense, and I thought, what, if I can start with 6 months of my rent, like saved up, just in case, half a year. To me, I felt
you can do that right away. That's amazing.
Well, making it semi-decent income, I did.
That's great.
And then I'm like, oh, I should try to do more, and it felt good. It felt good just knowing
amazing,
that, right? And it's just one of those feelings where I just was like, okay, all right, I'm a big boy now. I took some baby steps, and now I'm sort of like getting a little more comfortable.
Yeah. And some people even take it the next step. It's like they keep it in cash. Because once you have that cash, you can walk tall. You can
like cash, like you mean
cash.
not putting it in a bank, keeping the cash at home.
They just have a cash
in a mattress. The whole
basically like old school, because that what gives you that kind of like you can walk taller. You're like more comfortable. You're like, okay, I have that money.
I don't like cash. You know what? I sometimes I'd go a whole year and not ever touch cash, physical cash.
It's the new era.
I just don't like. I just got what do they call it? A wallet.
Yeah.
Digital wallet, and I'm kind of old school, so I'm like, I don't know about that. And I did it about 8-9 months ago, and I love it now because everything I use my phone. I just but there's still that little fear. I think being old school is still
that's the most dangerous these days, because you don't see the money, right? That's why we always tap, and all of a sudden your credit card statement comes. You're like, whoa, what did I do? But the thing is, when you're actually holding the real cash and you giving it to that people, sometimes you decide not to buy something, right? And that's where all the mindset comes, right? That's where we kind of get into the savings as well, because the savings is just mostly your discipline, your mindset. Because like when people ask, like, what's the best investment? Well, even if I gave you the best investment and you just don't have that discipline and habits, and you just have no clue how to save, that is not going to serve you well anyway. I could have the worst investment, but have all the knowledge and everything I know how to save and how money works. I'm probably going to have more money than you if you don't know what you're doing and you have the best investment, right? So the most important thing is knowing how it works, having the habits, having the self-discipline, and then we can work with those products that are available, right? So if you want to get like deeper into like how to save, investing, like you always have like a short term that would kind of go into that emergency fund, could go, right? The short term savings. And then you have the long term savings. So for long term savings, because people are like, you know, first like, okay, how much do I need to invest? And like, you know, what's the best rate? What's the best investment? And I'm like, well, it's the one that actually gets you to where you want to go. So where do you want to go? Well, I don't know if you heard of the concept of financial independence number. So which is basically
FIN. Yeah, I've heard about it
yeah.
before.
So what it is, it's basically a number that you need to, like, if you reach that number, that nest egg of saved money, by the time that you want to retire and never work again, you should, and that's what's going to give you the same standard of living.
FIN.
Yeah.
Okay.
Yeah.
All right.
So let's say, you know, you have to adjust it for inflation. So the easiest example would be like, let's say we have a 30-year-old making $30,000 a year. Now, you know, he wants to retire at 65. That's 35 years. Now, let's say the inflation, I mean, now it's crazy. Now it's like 7%, but past like 10 years, it was pretty low. So if we do like an average, you know, 3-4%. So in order for him to have the same standard of living as 30,000 is giving him today, he will need approximately, it comes to about 100 grand. So if he has that 100,000 a year at 65, the question is, how is he going to get 100,000 without work every single year and never run out of money just to keep that same lifestyle that he has today with 30,000?
I see.
So that would be his financial independence number. So if you calculate it, you know, the easiest just for numbers, because we were not really like writing it down, would be like, let's say he has an investment that gives him average 10%. Now, you know, people ask, where do you get 10%? That's for another topic. That's not the crazy part. That's actually pretty easy, but let's get back to it. So let's say he has that 10%. So now if 100,000 is 10%, how much is 100%? Well, you just add a zero, right?
Yeah.
So simple math. So that means 1 million. So in that scenario for that 30-year-old, his goal, his financial independence number at 65 is $1 million. Wow. So now he can actually calculate back, how much do I need to save every single month, starting today for the next 35 years without fail? What is that number that I need to save to get me to that 1 million?
Let me ask you this. What does he do next?
Okay, so once he has that number, right? So in that situation, you know, so we had, you know, his financial independence number is that 1 million. Now he needs to kind of figure out what that number is going to be that he needs to save every single month. So in this scenario, it's about $300, let's say, right? We can calculate it with financial calculator, but for a simple example. So now he has that budget, $300 every month for the next 35 years. Now, good question, Chris. Where does he put it? Now, what are the options in Canada to put money, right? So, you know, how people think about investment is, you know, when you ask them, they say, oh, I have TFSA. I'm like, okay, well, what's the investment? We'll say, well, TFSA. Well, no. TFSA is just the rules. The government gives you a limit. This is how it works. It's not taxable.
Yes.
Now, what is inside of it, right? The same thing. They say, you know, my RSP works better than my TFSA. Well, you could actually have the same investment in your RSP and in your TFSA. They could work the same because they're just the bucket. So the analogy I use is, if you go to a grocery store, you can take the basket or you can take the cart. Yeah. Now, let's say you buy a juice.
Yes.
Now, I can put juice into the basket or into the cart. Now, that juice still costs me the same money. It still performs the same, still tastes the same, still has the same color. It's the same juice. The juice doesn't know if he's in a basket or in a cart. But that basket, you can only put 10 of those juices. In the cart, you can put, you know, hundreds of them. Now, let's say there can be a broken handle or there can be a broken wheel. They have different rules, let's call it. Yes. Right? But it still gets you to the same cashier. You still pay the same money. Yes. So it's the same thing in the investment world. There's an investment vehicle. There's different baskets and carts, and you can still put the same investments inside. Sure. What people need to realize, right? Because there's a couple problems that's happening out there, right? Because, you know, let's say if we jump to a tax-free savings account, they called it tax-free savings account. Where do you go to get a savings account? Bank. What do they tell you? Oh, our rate is 0.5.
Yeah.
Well, what do you mean our rate? There is no rate for TFSA. It's a TFSA. It's a bucket. It has no rates. I could put stocks, bonds, real estate, whatever I want.
So is that just the bank's way of making money?
Well, to just kind of, because, you know, bank is a business, right?
Yeah.
They basically using your money to make more money, right? So if they can give you the least, better for them, right? Because if everybody would figure it out, we would kind of short them the money that they would make if we don't figure it out, right?
In my research, though, there's just so much information out there, Andre, that after literally it can just scare you into immobility, where you're just like, I don't know what to do.
Exactly. And then you do nothing, then the years go, and then you're not in your financial independence number.
I wanted to go back a little bit, though, about taxes. Like, how can I think that's a universal question.
Okay.
How can I minimize my tax liability legally? How can I?
Yeah, sure. Okay, we can jump on that a little bit, and then we'll come back
we'll
to those carts and baskets. Okay,
baskets.
We'll go grocery shopping. So, well, taxes, because, you know, if you think about it, in Canada, when you make money, they tax you. When you spend money, they tax you.
Facts.
When you save money, they tax you. When you die, they tax you again. That's actually the biggest tax bill you're ever going to pay.
Yeah.
You know why? Because you can't complain.
You're
already dead. Right?
So you have to structure it when you leave, your kids and your family are not left with a burden.
Exactly.
As someone who works in the film industry, though, I have a lot of friends and colleagues who actually get a tax ID or they incorporate. Is that an advantage? Does that help?
Well, it could be. I mean, you know, I can't really talk about taxes that much because I'm not like I'm not an accountant. It's a little bit different topic. But yeah, it could be. I know people that, you know, if they incorporate, they obviously take advantage of, they pay themselves an income or dividends, stuff like that, right? But good news, there is a lot of strategies that you can actually eliminate those taxes, right? To kind of answer your question, how do I, eliminate my taxes legally, right?
Legally, we're not going to be looking at Wesley Snipes at this point.
That's the next episode. But like when you take the income, right? Like when you're an employee, you have to pay taxes. Like it's automatically going out, right?
Yes.
But then, you know, if you're self-employed or a business owner, now you can take advantage of the tax write-offs, right?
Something I've been thinking about, a home business. What if I decide to have a home business or run a home business? Does that help me when it comes to the tax?
Oh yeah, because you can write off your expenses or your office, so part of your rent or mortgage, you know, your cell phone or whatever you can justify that you're using.
I take some notes here while you're talking. I put it as a question, but it's something that I'm thinking about.
But as I said, it's something that is for the accountants. That's a better question for the accountants. But it's kind of the knowledge, you know, out there when you are in that self-employed or business owner box, you can take advantage of the tax write-offs. Now, when you spend the money, we can't really, we can't be like, hey, I don't want to pay, 5% GST in the store. You kind of have to. Now, when it comes to saving money, there's a lot of strategies how to actually, save tax-free and actually pull out money tax-free. There's a lot of different options that, if people want to know about, that's something that we teach. And then, when you die and you pay taxes, there's also proper estate planning strategies that actually we can teach people how to go through and how to make sure that the family actually gets the money and doesn't go to the probate and estate, because if everything you own gets probated, right?
Yes.
Probate fees, executive fees, legal fees, disbursement fees, lawyers, all kinds of stuff. That
you get you just get fees,
and then it can be locked into the estate up to 3 years, and then whatever's left goes to the family. So with proper planning, we can actually avoid that, right? People have to have a proper will, because if you don't have the plan, the government has one for you, but you might not like it.
Well, there was one more thing I wanted to touch on before we move on to the other subject is debt management. And what I wanted to say about that, when it comes to debt management, what would you advise? Because I personally used to struggle with debt management until I employed a few things that I had to sit down and really think about it. I mean, I did some research, saw some different things, but I wasn't too happy, and I came up with my own method of managing my debt. What do you recommend to your clients when it comes to debt management?
It just depends what kind of debt they have, right? Because there's a good debt, there's a bad debt, right? So depends how much debt, depends how many pieces, depends how much the interests are, and then one method is the snowball method.
Never heard about
or the
that.
debt stacking. Some people call it debt stacking. So basically the simple idea is, let's say you have a multiple credit cards. Now, what do people usually do? They pay the one that has the highest interest, right?
Yes.
But you should pay the one that has the lowest amount.
Please explain.
Because that one clears the fastest. And now you feel happy because you're just eliminated a piece of your debt. And now you have that cash flow that you freed up to put onto the next one.
Okay.
But obviously it has to make sense. It's not like, like I have one debt that's 2% and then I have one 20%. And then the 20% has more money, so I'm going to pay the 2%. No, I'm going to pay the 20%, obviously, because that's a giant jump in interest.
Is it a smart idea to transfer? Because
Consolidate, you mean?
Yeah, no. Say the interest is high in one credit card debt that you have, and you have another credit card, and it's like we offering a way low interest rate.
Oh yeah, obviously, you always want to keep the interest rates the lowest.
How does that work, and how long does that process take? Because I never took advantage of it. I mean, there were times I could have.
Oh, there's different strategies, right? I mean, if you have some kind of line of credit that you already have for lower interest, and then you have some kind of debt on credit card, and then you just pay it off, right? It's just simple.
So it's taking a loan from the other.
Well, if you already have, some people already usually have a line of credit,
yes,
but then they're struggling with credit card debt.
Yes.
So why don't you take their line of credit, pay for your credit card, and then pay your line of credit? Because line of credit is usually lower interest than your credit card, right? So that's one way. But then let's say they have a lot of pieces of debt, they can consolidate, right? So it's, if it makes sense, because sometimes what they do, they give you like one payment, but then what happened to your credit cards? Now they're all freed up again. So people start using them too. Now they're even deeper and deeper. So
debt is one of those things that I think we as a nation need more education.
It's a debt culture here.
Because to me, it comes in two forms, like good debt and bad debt. So for me, good debt is like an investment opportunity, a business loan. Bad debt, personal loan. Car loan, and again, I didn't learn that anywhere. I just kind of figured like, oh my God, this doesn't make sense. And one of the tricks I would like to say I have employed in the past when it comes to debt management, I would literally before I buy something, it took a lot of discipline. I try to categorize it. Is it a need or a want? I mean, it's easier said than done. Okay. Do I want this camera or do I need this camera? This camera is $5,000 and I watched probably a YouTube channel with a guy who said, this is the greatest camera. It has, this and all the bells and whistles and stuff like that, dynamic range and all the things that makes filmmakers salivate and the creators, right? And I'm like, I want this camera. I really want it, but my brain is telling me I need it because it's like the best.
Exactly. But you could probably do your job with a camera that's half price and still would be the same quality.
Years later, I learned that lesson.
There's a lot of, some people break it down. There are even like absolute need. Let's say, I wouldn't survive without it, like food, shelter, all that kind of stuff. Then there's like need that kind of it makes me money or like I need it in order to have my life. Then there's the wants. Then there's stuff that you don't need. And the fifth one is just plain stupid.
What about sensible budgeting? It took me a while, that one too, budgeting, literally budgeting. And to me, again, that basic concept of don't spend more than you bring in, right? But when it comes to budget, I'm a late bloomer.
Discipline.
I'm a late bloomer in all of those areas because I had to really figure it out. I don't have anyone who can save me. I'm here by myself in this country. I have a family in Toronto, but that's it. So from New York to Vancouver, I mean, I can always call mom and hey, a 40-something, late 40-something man calling their mom and be like, hey, mom, can I borrow? I'm not going there.
You don't want to do that.
I did that once in my life, and I don't ever want to do that. And she reminds me every time. But anyway, for me, just knowing in my heart that I have no one to depend on, and I had to learn to budget.
Yeah.
I had to learn to practice, debt management. And I'm not the best at it, and I'm never going to claim that I am, but I think I came a long way, a very, very long way. And we've touched on so many great things here, but I want to talk about investing.
Yeah. So
What?
go ahead, because now I'm just gonna say that now we're kind of getting back to the grocery store.
Yes, exactly.
Okay, let's go back to grocery store.
Again, investing is one of those areas I was so terrified. Before I started, again, I told you 2 years ago I started tipping my toe, but I was so intimidated because it just seemed like this big machine and you need $1 billion to start. And there's all these misconceptions, misinformation, miseducation. I think that's the word that I want to use. Miseducation regarding investments or investing. Yeah. What do you tell your clients when it comes to investing? When they come to you and let's say I'm your client, I have a little bit of money. I feel a little froggy. I want to jump. I want to take a risk. I want to do something. What's the first thing you tell me to do? What do you advise me or educate me to do with that little bit of cash that I have, but the fear is still there?
Well, as I touched on before, it's like people usually say I want to invest. Like, what's the best investment? What's the best rate? They're like, oh, I don't have enough money to invest. The question is like, what is enough money to invest? Like, that's always my question, because I kind of, grew up with kind of my dad kind of, throwing me into the pool of entrepreneurs and financial people and millionaires and people who have their stuff together and who teach this. And then that question was like, what is enough to invest? Like, what do you mean by that? Is it $10? Is it 100,000? Or like, how much do you actually have? Like, when do you feel ready? Because for me, I know what the minimums are. So the minimums for most of the funds out there are $25 a month or $500 nest egg. So when people tell me, it's $25 a month. So people are like, oh, I don't have money to invest. I'm like, well, do you have $25? Then you can start investing. Because what happens out there, it's like, I don't want to name institutions, but I was at this festival one time, and it was just like a street festival. They had a booth, and there was this guy in a suit, and they had like a win-free iPad, and just put your business card in, and there was this little questionnaire that you had to fill out, and it asked you, is your household income more than $200,000 a year? And I asked him, I'm like, hey, why is this question here? He's like, honestly, bro, if you say yes, I'm gonna give you a call. But if you say no, nobody's going to ever call you. And I'm like, why is that? Oh, because you just don't have enough money to invest. Like, we can't do anything for you. Like, you were a waste of time. And I'm like, but...
So wait. It's the professionals in the industry who sort of like kind of spark that misinformation. That's separate. Because, see, the average person, the average individual out there would be like, yeah, these guys wouldn't want to mess with me because I don't have money.
Yeah, but that's the thing. They don't want to mess with you, but they could, because there's no such a thing as premium investing. Like, it doesn't exist. Like the same expertise that the rich people are getting, everybody can get, because it's the same concepts and strategies, and then you just choose the same investment they're doing, and then you just it might be a different number. Maybe you're not starting with $1 million, you're starting with $25, but you still can have the same vehicle, the same investment that they have, the same goal, the same, it's just the same thing, just a different number. But people don't know what they don't know, and that's why, because a lot of the people in the industry have quotas, right? So they rather chase the 5% people who have money than the 95% who don't have any money, and they don't want to pay for advice, and they think it's like they're too broke, they don't have any money, and then, because these guys kind of put them on it, put that on them. That's what I want to say. So, right, it's kind of this like preconceived thing that we think that like we're not good enough for like the expertise. We need to be some kind of a Bill Gates in order to get investment advice. Like, no, like, it's out there. You just need to get somebody who guides you, who has that access to those companies that do that, and then applies that for you and teaches you how to manage it, right?
So someone like myself who, like, I wouldn't say I'm totally mistrusting of the industry, but I wanted to learn. And I went and did my own quote unquote research. And what I found very quickly, what I found out was investing in financial issues or becoming financially literate is not that difficult. It's just your mindset.
Exactly. It's just your mindset, habits.
And the second thing for me that I found out was I realized I work for that money, you know? So I want to know where it's going. I want to have at least an understanding. I'm not going to,
Yep.
you know, all of a sudden become a financial professional, but I want to understand. When
Yeah.
I'm sitting in that chair talking to my educator advisor, I want to understand. I don't want him to, after him or her having to explain to me 20 times, and
Yeah.
I still can't wrap my head.
Yeah.
You know, it's just an understanding of where my money is going, why it's going there, what are the returns I'm expecting, what are the risks as well. And for me, once I kind of broke through that cloud, I felt a little bit more confident.
Mm-hmm.
And it's very liberating, I have to admit.
It is.
There's still some, like, you know, reticence on my part, because there's
Oh, yeah.
certain parts
Yeah,
about the
step by
industry,
step, right?
yes, that I don't feel
Yeah.
comfortable with.
First, you need to figure that out. Then this. Then once you know your financial independence number, now you know that budget that you need to save every single month for those whatever years that you have until retirement. And now back to grocery store, we
Yes.
go. We have that RSP out there. We have open investments, which is basically the same thing. You just don't register it. It's kind of like your regular savings account.
Is it risky? Is it riskier than the registered?
They're all just bucket. They have no risk. They're just rules. They're remember the grocery store baskets or
Yes.
carts.
Yes.
They're just carts. They don't know what's inside yet.
Okay.
Now, there's TFSA, and then there's something that we refer to as personal tax shelter.
Yes.
And so the RSP is the one that everybody knows because, your mom does it, your neighbor Joe does it, everybody does it. They say on the radio, it's RSP season, right? But not many people know actually how it works, right? So the RSP is 100% taxable, right? They give you a little refund. You can write it off from your taxes. But most people just, what do? Like, oh, I saved $5,000 on taxes this year. We went to Mexico. Well, they don't know that it's actually 100% taxable. So later on in life, when they will withdraw the RSP, everything that's in it plus the growth will actually get taxed on their whatever tax rate that they will end up, because
Lovely.
it's taxed as the last dollar earned, right?
Yep.
So a lot of people might get killed in taxes later on, and then they say, oh my God, well, I've been lied to. The government didn't tell me all of this stuff. Well, whose fault is it? Theirs or the government? We don't know. Probably a little bit both, right? There was no education on both sides. Then you have the open investment, which there is no limit. There you get your T5 every single year, right? How much like capital gains? So half of the growth is taxable. So that's capital gains, right? Now the third bucket is the tax-free savings account, which, as we talked about, it's called savings account, and that's why most people are using it wrong, because it's 0% tax. So it's the best vehicle to grow your money tax-free and pull them out tax-free. But now who cares that it's, no tax on the growth, where there is no growth for most people because they're using it for 0.5% account. And if you remember that rule of 72, now if you're getting 0.5% on your TFSA, 72 divided by 0.5, that's 144 years to double your money. Now, how many 144-year doubling periods do you have, Chris?
No.
Right? So that's why most people are not making it, right? And they say, oh, TFSA is not good because I'm only making 0.5%. Well, yeah, because that's just your bucket. Now, you can choose that account that makes you 10%, or, you can put anything you want in there. That's why they have to kind of separate that shopping bag from the actual groceries.
So let me ask you this. What would you call a TFSA account then?
So, Chris, I would call it tax-free investment account or tax-free retirement account, because, people would actually use it for what it should be used for their retirement or investments. They wouldn't treat it as just another savings account and go buy groceries or pay rent from it, right? And then as we go next, we have the fourth vehicle, which we could probably spend another episode about, which is the personal tax shelters, which involves way more moving parts in order to get it right, because every situation is different, right? And that's kind of, when it comes down to it, the whole financial foundation, as we went through it, the proper protection, the debt management, the emergency fund, and the investments, it's the same thing for everybody, but it's different, right? Like everybody has different parts in it, and we need to know where to put our budget and kind of properly structure it, right? But the whole thing is about, I would say people shouldn't think that this stuff is just for the wealthy few out there, that actually everybody can get this information and take advantage of that simple concepts and strategies that are out there, and they can actually apply them to their life to get into that, to reach that financial independence number that they have. So once they have a goal and a plan and they stick with the plan, then everything's going to be better. Hopefully, you know, I shared some stuff that could improve some people's situations long term. And
certainly did mine. I want to thank you so much for coming out today, giving us your time. Traffic, I know, was a little crazy getting out here today, but I truly appreciate you, brother. And for the viewer at home, I just want to say thank you. If you find any value whatsoever in this episode, get into the comments section, subscribe, like, leave a comment, leave a question, because Andre's definitely going to be back, right?
Yeah, if you want me back, sure.
I definitely want you back. So thank you again, Chris Rogers, Real Talk.